In 1345, the three largest banks in Europe collapsed in the same year. Not because of bad investments, not because of fraud, because a king refused to pay his debts, and the entire monetary system that depended on his word dissolved overnight. That king was Edward III of England. The banks were the Bardi, the Peruzzi, and the Acciaiuoli, Florentine banking dynasties that had spent decades financing European wars, trade routes, and royal courts. When Edward defaulted on loans equivalent to several times England's annual GDP, all three failed within months of each other. But here is what nobody tells you about that collapse. The banks were not the cause. They were the symptom. The real problem had started a century earlier, underground in silver mines that were quietly running out. And the solution that Europe invented to replace that silver is still running your bank account today. For 3 centuries, roughly 1000 to 1300 AD, Europe ran on a beautifully simple monetary system. Silver went in the ground. Silver came out. Silver became coins. Coins became commerce. No central bank, no interest rates, no monetary policy. The money supply was controlled entirely by geology. When mines produced well, economies expanded. When mines slowed, economies contracted. It was brutal, inflexible, and completely honest. A coin was worth exactly the silver inside it, nothing more, nothing less. Europe's main silver came from mines in Germany, Bohemia, and the Iberian Peninsula. At peak production in the 13th century, these mines fed a commercial revolution, trade fairs in Champagne, Venetian merchant fleets, Florentine banking houses handling transactions from London to Constantinople. Then the mines started dying. Not dramatically, not overnight. Slowly, over decades, the easily accessible silver deposits were exhausted. Extraction became more expensive and less productive. And simultaneously, every luxury good Europe wanted, spices from Asia, silk from China, cotton from the Islamic world, had to be paid for in silver. The metal that backed European commerce was draining eastward one trading season at a time. By 1300, Europe had a problem with no obvious solution. The economy needed more money. The ground could not provide it. Then in 1347, something arrived in Sicily on a Genoese trading ship that made the silver problem look minor. The Black Death killed between 30 and 50% of Europe's population in 4 years. Entire villages disappeared. Agricultural output collapsed, and critically, silver mines stopped functioning. Mining requires skilled labor. When that labor dies, the mine dies with it. Europe now had 2 simultaneous crises, a monetary system built on metal. And no metal coming out of the ground. What followed was not inflation. It was something more terrifying, deflation. With fewer people, demand collapsed. Prices fell, but wages fluctuated violently. Tax revenues evaporated. And rulers who needed silver to pay armies, maintain courts, and project political authority faced a simple equation with no solution. No silver. No power. Here's where the story gets interesting and familiar. The King of France, Philip IV, had a problem. He needed money to fund wars. Silver mines could not supply it, so he did the only thing available to him. He debased the currency. Philip collected old silver coins, melted them down, and minted new ones with less silver per coin, keeping the difference for the royal treasury. On paper, the money supply expanded. In practice, every merchant in France immediately noticed that coins were lighter, prices adjusted upward to compensate. The first recorded inflation in medieval Europe was not caused by abundance. It was caused by a government secretly stealing from its own currency. Sound familiar? Philip did this repeatedly. Each time, trust eroded a little further. Each time, the adjustment came faster. Merchants began demanding more coins for the same goods, not because goods had changed, but because nobody trusted the coins anymore. The lesson of 1300 is identical to the lesson of 2023. When a government cannot fund itself honestly, it funds itself through the currency. The mechanism changes. Medieval kings melted coins, modern central banks expand balance sheets. But the mathematical result is the same. The purchasing power of ordinary people quietly transfers to the state. But here's the part that almost no one covers. The crisis did not just produce corruption, it produced the most important financial innovation in human history. Italian merchants, specifically in Florence, Venice, and Genoa, had a problem. They were trading across thousands of kilometers. Carrying physical silver on those routes was dangerous, expensive, and increasingly scarce, so they invented something to replace it: the bill of exchange. A Florentine merchant in London could deposit silver with a banker there and receive a written document, a bill, promising payment in Florence. No silver moved, no coins changed hands, just a piece of paper representing a promise. This sounds simple. It was revolutionary. For the first time in history, money was separated from metal. Value existed not in a physical object, but in a written promise backed by institutional trust. The Bardi and Peruzzi banking families built entire European networks on these instruments, effectively creating a private monetary system that ran parallel to the royal coin system and was completely independent of silver mines. Europe had run out of silver, so it invented credit. And credit, unlike silver, had no geological limits. Here's the uncomfortable truth about that invention. Credit solved the scarcity problem, but it introduced something far more dangerous: fragility. Silver cannot default. A coin is worth its metal, regardless of what anyone believes. Credit only functions as long as everyone in the chain trusts everyone else. The moment that trust breaks, at any point, the entire network collapses simultaneously, which is exactly what happened in 1345 when Edward III of England defaulted. The Bardi had lent him the equivalent of roughly 900,000 gold florins. The Peruzzi had lent him 600,000 more. These were not reckless loans. Edward was the King of England, financing what seemed like a manageable war. But wars became expensive, revenues fell short, and Edward simply stopped paying. The banks that had solved Europe's silver crisis, that had kept commerce alive through the Black Death, collapsed within months of each other, taking with them the savings of thousands of depositors across the continent. The solution to scarcity created a new kind of vulnerability, not geological, human. Europe did not run out of silver and collapse. It ran out of silver and invented banking. Then banking collapsed, and it invented central banks. Then central banks printed too much, and it invented inflation targeting. Each crisis produced an innovation. Each innovation introduced a new vulnerability. Each vulnerability eventually became the next crisis. The system never stabilizes. It mutates. What stays constant across 7 centuries is this: the people who understood the current form of money, what backed it, who controlled it, how it could fail, consistently positioned themselves ahead of those who simply trusted that the coins in their pocket were worth what they said. Medieval merchants who adopted bills of exchange, while competitors insisted on silver, survived the shortage. Florentine banking families who overextended credit to kings learned the cost of misplaced trust. Today, the question is not silver or gold or paper. It is who controls the creation of money, under what constraints, and what happens when those constraints break. The answer has been the same since 1300. Those who understand the mechanics of the current system before it changes win. Those who discover how it works only after it fails pay. Europe ran out of silver 7 centuries ago. It invented something to replace it. We are still living inside that invention, and it is still running out of something.